Anna is being very brave and being our first person. Hopefully there's no technology issues and it's going to work out fine, but I'm looking forward to my financial IQ being increased. So thank you. You're up.
Well, thank you everybody for coming out on this gorgeous Friday, of course, to talk about financials over lunch. What a lethal combination. What a way to be a sleeper. But I'm trying to, this should be very interesting, hopefully for you guys. I know for me it's thrilling. But anyway, we're here to raise your financial IQ. Let me tell you a little bit about my company. We do day-to-day accounting and financial management for small and mid-sized companies. What does that mean? We help businesses increase their profits, manage their cash, and get better control over their financials. We do that a couple different ways. We have controller services. We do analytics like KPIs and dashboards. And then we also do accounting operations consulting for those of you who have accounting departments, helping them streamline their operations and make them work efficiently. And we also do day-to-day accounting and bookkeeping for our clients as well. So when we work with clients, there are typically three camps. And I think there might be three camps in this room today. The first is, I don't understand what all those numbers mean. Therefore, I will bury my head in the sand until I have to talk to my CPA at the end of the year. The second is, I have a staff who takes care of that stuff for me. I trust they're looking out for us. And the third is, I know my numbers, but I want to know what I don't know. Or I might already have a staff and I might need just a little bit of some clues to look at to see if they're doing things the right way. So I thought I'd start with a little bit of a fun exercise to see how awake you really are and how observant you really are.
This is an awareness test. How many passes does the team in white make?
Go!
The answer is 13. But did you see the moonwalking bear?
Go!
How true is that, right? It's very true that you don't know what you're not seeing. It's very easy to miss something you're not looking for. That actually was a commercial for bikers on the road, whatever, but it serves my purpose, meaning if you don't know what your financials are, you won't be able to spot the bear. You know, we're so busy day to day, passing the ball, making sure everything is getting done, and we're focused so much on the ball, a moonwalking bear theoretically could walk through our mess. What's the bear? I'll refer to a lot in my presentation. The bear could be any one of these things and more. Little creeping costs, profit drains, things that are, starting to eat away at your business, cash flow issues, competition entering, effects of the economy. All of these things can be this bear that walks through your midst, and without you understanding your financials and taking your eye off of the ball, you may potentially miss it. So today we're going to talk about taking your eye off of the ball. Really taking a step back to spot the bear by using your numbers to do that. It'll help you both refocus, measure your performance, and more importantly, course correct before it's too late. So what we're going to do is we're going to start with the basics. We're going to talk about the individual financial statements. We're going to talk about some of the trouble that we run into with our numbers, specifically around cash flow. We're going to also take a look at some real live financial statements. And we're also going to look at what we look at when we are working with our clients from a controller perspective, so that you can go back to your staff and say, all right, these are the things we should be looking at each month. We'll tell you what we look for. This way you can kind of be more educated to look for it for yourself. Whether you do your books yourself, whether you have a bookkeeper that does it, or you actually have an accounting department, these all apply to all of you. So there are three financial statements: the income statement, the balance sheet, and the cash flow statement. The income statement is also called the profit and loss statement. It records your revenues and your expenses. Pretty simple, probably the most easily understood. Everyone says, okay, what is my profit? Balance sheet is a little bit less understood. It's, in simplest terms, what you own and what you owe, okay? That's where you'll hear things like assets, liabilities, equity. These are all things that allow you, it shows the stability of the business. And then the last financial statement is the cash flow statement. It answers the million-dollar question of where did all my money go? It's probably the least understood, but we'll take a look at it and we'll show you why. Okay, so what I thought might be helpful is if we actually looked at a company's financials. Now we're not going to put our green visors on and get our little accounting machines out, but we're really going to start just show you some examples of what a financial statement looks like. Okay, so what we have is a sample company called Larry's Landscape Design. So we'll start with the income statement. So that's the second page. It says Larry's Landscape and Garden Supply profit and loss prior year comparison on top. Okay, so the income statement starts with revenue. And there's one thing about bean counters, they like consistency, right? We'd like to see the same thing on every financial statement. So whether you're a manufacturer or a service provider or a distributor, every financial statement has these key components. What's in between these components all changes depending on your business and how you've set up what's called the chart of accounts. So everyone starts with revenue. Revenue is your sales. So if we look at Larry's classified as revenue in a couple of different areas. He's got landscaping services, he's got retail services, then he's this other bucket called services. So everyone's revenue line may be different. Below that is your cost of goods sold. Now Larry doesn't break his out, but cost of goods sold is really what is the things you need to buy in order to produce your good or your service. So if you were a manufacturer, it's very easy, right? You have to buy the material that goes across the line, and you got the labor guys that are doing the that are making the products. But if you're in a service business, it might be a little bit different. You might have to hire subcontractors, or if you're a web designer, you may need web services or printing expenses, that sort of thing. So that all is really important for you to classify those appropriately. So for those of you who have staff, this is one area when we walk in, we find that there's a lot of variable costs that are held below the line, below cost of goods sold. So we like to just go through it with the clients and just say, look and see, really, do any of these things need to be reclassified above the line? Because it's really important for you to get to your gross margin, or also called your gross profit. This number is one of the 3 critical numbers that we look at for everybody's business. We look at it typically as a percentage of sales, but the gross margin is the money you have left over to pay for the rent, to pay the lights, to pay that office manager who keeps the whole ship running, but nobody gives her any credit and she really feels underappreciated. She rolls into those costs that fall below the line. So gross margin is really important for us to look at. And we look at this very closely for our clients. And we're working with a client right now who's in a turnaround situation. And she's really trying to measure her gross margin. We're keeping a very close eye on her gross margin because her margin is very, very thin. For those of you in bigger businesses, we would recommend that you do a good, clean matching of your revenue and your expenses through accruals. What we're finding with this client is 1 month, prior to us getting in there, 1 month her gross margin was 52%. Next month it was 25%. This month it's 45%. Now it's 20%. So what happened was revenues were hitting in 1 month and expenses were hitting in another, so we couldn't get a really good read on her gross margin. So what we've done is we've matched the revenue and expenses to the same period, and therefore we're getting a really good read on truly what her gross margin is. So gross margin is really important because that's the money that's left over to pay for everything else.
In this case, when he's got all the payroll to deliver his services below the line.
Correct.
Okay.
So
Fix that for them.
I would fix that for them. And that's actually one of the buckets where we have to clean up most of the time because there are people who are directly involved in doing the delivery of the service, and there are some people who are keeping the ship running behind the scenes, answering the phones, running, finance, etc.
Any materials cost?
Materials costs go above the line. Those would go in cost of goods sold. Yep. So,
What do you say is an example of a cost of goods for a service company?
so service company, you're in, okay, so if you had to, so the cost of your trucks, gas, tolls, fees, parking, all of that would be in cost of goods sold.
And how is that different from the other expenses?
So the other expenses don't vary with the amount of volume.
That's overhead?
That's just overhead.
Oh.
Yeah. So we can look at some of the things that Larry's got classified in overhead. So advertising, insurance, office supplies, rent, repairs, utilities. So that all falls what we call below the line, but those are your overhead or operating expenses, and that of course gives you your net income. Your net income is what Uncle Sam looks at to tax you. Okay. The next statement is the balance sheet. And if you turn the page, we'll take a look at Larry's balance sheet. Shows you what you own and what you owe at a point in time. So the way I like to do it in layman's terms, what you got, how'd you pay for it, right? So what you got are your assets. It's what you own. So Larry's got cash in the bank. You see under current assets, he's got checking, he's got money in the bank, he's got accounts receivable. That's the right to collect money from a client. And then he's got other assets. If you go down kind of middle of the page, you'll see he's got trucks. So those are his assets. Those are the things he owns. Well, how do he pay for it? Some of it goes on, he put on credit cards, and if you go down and you turn the page, actually there is some loans on the books. So those are his liabilities. And then on the bottom is your equity, which is what you own when you take away your assets and your liabilities. It's not an indication of what your value of the business is in the market, it's what your stake of the business is at the end of the day. Now the cash flow statement is the third statement that we're going to look at, and that's on the next page. This is where you need to put your CPA goggles on, but I don't have any today, so we're going to go with the way that we look at it or the way we explain it to our clients. The cash flow statement is probably most difficult for us to explain, but it is the most powerful financial statement, I believe, after the balance sheet. So when I work with a client, I first look at their balance sheet, and then I go directly to the cash flow statement. It tells me how healthy this business is. Okay, so the cash flow statement, what I tell my clients is really just look at three categories: the cash provided by operating activities, investing activities, and financing activities. So what the cash flow statement is, if we go way to the bottom of this cash flow statement, it says, what's the cash at the beginning of the period and how much is there? Does anybody see that on the second line to the bottom? How much is there? $218,000. At the end of the period, how much did he have? $105,000. Where'd the $100,000 go? That's what the cash flow statement tells you. So let's look at the three buckets, okay? Cash flow from operating activities, he lost $100,000 right there, okay? Cash flow from operating activities is the daily, how much money the business current operations are generating. It's when you're selling your service or you're making your product, how much money is that actually generating? How well are you managing your payables and your receivables? That's a core number for the business, cash flow from operations. So we see that he lost $100,000. That's the first subtotal, middle of the page. 101, 685, 84. Net cash provided by operations is actually a negative. So he actually lost a lot of money just from his daily operations. And as a startup, that might not be out of the norm, okay? I would want to see that number stronger. But he's got to have to pay for it somehow. Investing, the cash flow from investing activities is, when you have cash in the bank or your business generates cash, and you might take some of that cash and you might say, all right, well, I need a new truck, or I need to buy new equipment, I need new computers. I'm investing back in the business. So I'm taking that cash and I'm putting it back in the business. So that's cash flow from investing activities. sometimes you have to borrow money to do that, right? So I might get a loan, I might take money out of my pocket and put it into the business. I may take money out of the business if it's doing well and put it back in my pocket. That's cash flow from financing activities. So this statement, to simplify, just look at the 3 categories, and that will help you determine where the money is actually going. So when people say, I'm selling $1 million and I have $100,000 in the bank, where did it all go? The cash flow statement is a great place to start to look at to find where those answers may be. I don't know if I need to cover this in way detail, but I'll do it anyway. Cash flow versus profits. If anybody has ever struggled to make payroll, I think you understand the difference. If you've ever, we actually started working with a client that had a conversation with a CPA 2 weeks before April 15th and found out that he owed $300,000 to the IRS, and he had $50,000 in the bank. And he's like, how is that possible that they can tax me on something I don't have? That's the difference between profits and cash flow. Rule number 1, net income does not equal cash flow. Cash flow is what actually goes in your bank. Net income only shows you what was invoiced and what expenses were recorded, not necessarily the flow of money. This is a little difficult to understand, so I put together a really quick example. All right? So let's say we're a company and we're going to invoice our customers $500. Great, we had a great month. Maybe add some zeros behind it, 500,000, but let's say we've invoiced them $500. Well, we had to pay our supplier for the inventory, which we recorded as an expense, cost of good, for $100. Okay, so we paid our supplier, and we have net income of $400 on the books. Sounds good, right? Not bad. So how much cash actually changed hands?
$100.
Only the $100, because we only invoiced our customers, they didn't pay us yet. So in essence, that $400 doesn't mean anything, because really we are out of pocket $100. Does that make sense? Mm-hmm. So that's the difference between cash flow. If I were only looking at profits, I'd be saying 400, woohoo, we're doing great. But if I were looking at my bank balance, I'm like negative 100 and we're in trouble. So this is the difference. The IRS would be taxing me on that 400, depending on which basis you file on. But let's just say for the most part, they'd be taxing you at the 400. You can be profitable until you file for bankruptcy. If you're not collecting from your clients, if you're paying your vendors too fast. And we're going to go through a lot of things that can help you improve your cash flow in your business. The top ways for you to improve your cash flow from an accounts receivable perspective, okay? Number 1, please make sure the right purchase order numbers are on the invoices. So simple. Many times we walk into clients and some of the solutions to their problems are simple things like making sure the invoicing goes out correctly, right? Making sure your purchase order is correct, has all the numbers, and you haven't exceeded it before you send the invoice to the client. Especially if you're dealing with Fortune 100 companies. Purchase orders are the lifeblood of their vendor management system. So if you get it wrong, you get stuck in the queue, and sometimes they won't even let you know that they've kicked it back out. So it's really important to understand, and even with mid-market companies, depending on how stringent they are, but Fortune 100s, make sure your POs are all on your invoices. Email versus mail. We have a client that we're working with now that they call it the vortex of the postal system. Like things come, they don't come, but they insist on sending their invoices out via mail. Well, first of all, half the times they don't get it to their client, but then what you're also doing, think about it, if you have the option to email your invoice, but you choose to do paper, you've now added 3 days to your cash flow cycle, right? Between the time you print the check, lick the stamp, well, I guess you don't lick them anymore, but put the stamp on and you send it out, that's 3 days. And then another day to process internally, so if you're in a big company, forget it, 4 days, almost half a week, more than half a week, you've added to your cash flow cycle. And oh, by the way, most of our clients who are the Fortune 100s are now putting the pay date of their invoices based off of the date it was received. So no matter that I I write on my invoice that I'm doing an invoice date of, say, 8/31, if they don't get it to 9/6, 9/6 is the day that they start calculating their 60 or 90 days. It's crushing from a cash flow perspective. Okay, so really, if you can get it, the faster you can get it there, the better off you'll be. Simple, making sure it's being sent to the right place. So a lot of times our clients have client counterparts that are either in marketing or they're in engineering or they're in sales, but there's a whole AP department that nobody talks to. So they're sending invoices back and forth, and the other person on the receiving end, on the client side, may not be forwarding it on. Make sure you know who to forward it to. Take credit cards for small stuff, please, please, please. For the 3% that it costs you, the headaches that it will save you are more than anything. We had a client that does web design and also does some small printing jobs. He prints business cards. So he was generating invoices for those $40 or $100 charges, sending it to him for having his bookkeeper send it to him for approval, sending it to the client, and then having to make 4 or 5 collection calls on that $40 or $100. What happened to that margin on that one sale? Gone, right? Had him take credit cards. He pulled them right. He improved his cash flow immediately. Technology is allowing it now that there's a lot of companies for smaller businesses called Bill.com where you can do invoicing and they can pay you directly. A lot of the larger companies, by default, you go to their ACH. But I think technology and banks are getting smarter that these paper checks are just trouble all the way around. A lot of openness for fraud, et cetera. So we're seeing a lot more electronic payments, and that's a huge, if you can get them and you can ask them, getting on ACH or direct deposit is huge. Simple things, send a statement. I mean, you send a statement to an AP department, they're like robots. They go through and they say, do I have all this? No, and then a lot of times they'll email back and say, I don't have these 6 invoices. Well, if you don't send a statement, you're waiting until that invoice goes past due, and then you're picking up the phone and calling, thinking that it's in their process. So send the statements, be the squeaky wheel, especially when you're working with mid-sized companies. A lot of times their accounting departments aren't as sophisticated or have as many rules as the larger companies. So the squeaky wheel gets the oil, and if you're lucky, you have an uneducated person on the other end of the phone, and they will pay your invoice over somebody else because they just don't want to hear from you anymore. So be the squeaky wheel. Negotiate better terms. Larger companies are a little harder to do, but if you are able to, extend, say, you can pay me 15 days with a discount, offer terms if you possibly can. And if not, see if you can negotiate upfront deposits. That's on cash coming in, right? It's all about speeding it up. It's all about getting it there faster, getting the money back faster. On the AP side, right, we want to slow it down. We want to slow it down so that we give ourselves time if our clients haven't paid us before our vendors are sticking out their hand saying, I want my money. So what we're going to try to say, the first thing I would say is do not rely on your bookkeeper to manage your cash flow, okay? We currently are working with a company that's about $7 million, a distributor, very complex, inventory, AR, AP, and they had a clerk managing their cash in a, one of those spiral flip notebooks, the assignment pads for the kids, that's how she was managing their cash. God bless her, she kept them afloat for like 7 years. However, we call the CEO the rogue CEO because he would just go and spend, and then she was kind of coming from behind trying to make it happen. The only problem is by not taking ownership of the cash flow is that you're at the mercy of if you're not watching it, the bookkeeper can pay things that may not be the highest priority. So do not rely on your bookkeeper. Make sure you as the owner know what's coming in and going out and how those decisions on what she's cutting are being made or he's cutting. Same thing with your controller too. Pay according to the terms and not sooner. we have a lot of clients that were like, wow, I like this person, we have a really good relationship, I know their terms are 30 days, I'm paying them in 10. Well, I don't like to condition people to expect that check in 10 days, because if I'm stuck or my client is stuck and they haven't received the money from their client, it gives them the wiggle room without damaging a relationship. So pay according to terms. Ignore the squeaky wheel, okay? So you may be getting calls from your people you're selling to, and they want, or sorry, that you're buying from, and they are calling and calling and calling. The biggest challenge that we see with clients, and this is why we say don't let your bookkeeper do the cash forecast or the cash flow, is they will pay whoever's on the other line to get them off of the phone. But it may not be your most strategic payable to pay, for example. So this example that we walked into, the bookkeeper or the clerk was paying who is the squeaky wheel, yet she was on credit hold for some of their key suppliers, okay? Because she didn't pay them, she's paying Staples, who was calling her for, for $150. So when you're on the other side, you want to ignore the squeaky wheel, but you want to be proactive rather than reactive, right? So it's all about taking control over your payables, taking control over who you're going to pay and when you're going to pay them. And that's why having a team between you and the accounting person or the controller is important for you to have a strategy around, yeah, we got this big influx of cash. I'm not going to just start dashing off checks because I know I'm going to be proactive, because I know in a couple months I'm going to be short, or a couple weeks I'm going to be short. So I'll tell you a little bit about that in a second. Really critical, stratify your vendors. Who is going to put you out of business if they stop shipping to you? Who is going to cause a lot of trouble if you don't pay them? And then stratify them. Then who can you pay next? Who's not going to shut you down? Who's not going to shut down the operations? And then who's the non-criticals? So if Staples calls you and is begging for their money, there's 7 other office supply houses. If you're really stuck, you got to prioritize. You'll pay Staples, but you got to just prioritize. Nobody's going to go. Business is not going to stop if there's not enough pens in the office. You know what I'm saying? Ask for extended terms. This is where the proactive comes in. Ask for extended terms from your vendors. Ask them if you can pay them in 45 days, 60 days. If your client's paying you in 90 days, ask them if you can pay when paid. That sometimes flies, not a lot of time, but it can't hurt to ask. If you don't ask, the answer is always no, right? Really critical, meet your obligations and communicate if you can't prior to missing the deadlines. Keeping that good relationship with the vendors will keep the relationship open for when you are in a pinch to stretch them if you need to, if, say, for example, you're not getting paid by your clients. Cash flow forecast, cash flow forecast, cash flow forecast. This is one of the most critical yet undone activities in an accounting department. It's such an empowering exercise to do because it gives you the visibility to be proactive rather than reactive. It allows you to see what I have lined up to pay out in the next 6 to 8 weeks, preferably 13, but let's not push it. We'll go 6 to 8, and know if my client doesn't pay me, what do I do? And then you move the pieces around a little bit. It gives you the visibility to say, okay, my client pays me 1 week late, which vendors do I need to pick up the phone and call and tell them I can't make it, their payments, okay? Or I'm sitting on a boatload of cash. I'm tempted to write all these checks, but I know in 3 weeks, my workman's comp audit's due, and I know I have a huge payment coming out, okay? So a cash flow forecast, many of the software packages out there today have some sort of canned cash flow forecast in there. What it does is it takes your payables and it lays it out over the next so many weeks, and it tells you, kind of lays these things out for you, okay? Why don't we look at some of the statements that we look at on on a monthly basis. So in addition to kind of helping our clients manage their cash flow, we look at their financial statements to identify any trends or trouble spots. And there's a suite of reports that we run every month, and these are what we consider the critical ones, okay? So the first is your profit and loss year to date versus prior year. And what we look for in here is any kind of swings relating to, just be able to explain any of the swings that we see. So if sales have gone up versus last year, great. If sales are down versus last year, why is that? Another comparison that we also like to look at is year-to-date budget versus actual. I don't have one in here. Same concept. You look and see what you've got versus what you had planned to have. The balance sheet variance analysis, current year versus prior year. That helps to identify if there are any large swings. We look at that as well. So these are critical reports to kind of help find a couple of things. Are there issues in the business, but also is my bookkeeper, accounting staff, or am I recording everything properly? Of course, we talked about the cash flow statement, but let's switch over to the P&L by month. So this is only six months on this, but what we do is we normally run a full year, or at least a rolling 12 months to look at the profit and loss statement. This is a really, really good report to help you identify if there's any trends going on in the business. So if we look at Larry's, we can see starting in June that, September, October, and November, he's really starting to ramp up in sales. Okay? So when you look at your financial statements in a trend, it tells a really good story, or it tells you a story. It may not be a good story that you may not want to hear, but it tells you a story of what's going on in the business. What are the trends doing? All right? So if you look at that, it also tells you, am I missing anything, or something like misclassified. It's very easy to do when you've got a lot of transactions. You can see if you go 1, 2, 3, 4, and under expenses, there's a delivery fee, right? So he's got $25, $85, $0, $15. So my question is, what happened to the delivery fee in September? Excuse me. So it tells me that's one way that we look at to make sure our bookkeepers are recording everything properly. This is part of what we call our controller review. And so what we do is we look to make sure everything, over time makes sense or going up. So the profit and loss by month is a great way to see if there's any issues and for you to understand what direction your business is going. The balance sheet by month, which is on the next page, also allows us to take a look at the trends, okay? So what I look at on the balance sheet by month, I look at, of course, the bank balance, where is it heading, what direction, knowing that these are snapshots, point in time, point in time, point in time. So we just look at what is the trend directionally. If we took snapshots all the way around, it's almost like you get the motion view. We look at, are they buying new equipment? Are the truck costs or the truck line going up, or fixed assets? Are we looking at, are things being depreciated? Are accounts payable going up? Are accounts receivable going up? Are our sales going up? Or are they not collecting? So that's the P&L by month, the balance sheet by month really highlight a lot of the trends, and they also highlight a lot of the errors that can be made as well. The last two reports are the accounts receivable aging report, which I bet a lot of you look at. This is what people owe me and how far past due it is. This is a great report for you to look at, if not weekly, monthly, who owes you money and how far away are they, or how far past due are they. Luckily, Larry, it looks like he only's got one client that's in the 1 to 30 day category. So current means that the invoice is not due. 1 to 30 means it's 1 to 30 days past due, etc. 31 to 60, 61 to 90, etc. So obviously you want your receivables to be as current as possible. So this is another critical report. And what these reports are, and the AP on the other hand, is how much you owe people and how far past due, and Larry seems to be pretty current with his suppliers. The way I look at these suite of reports is it creates a I don't want to say a box, but some control mechanisms into making sure that your financial statements are accurate every month. And it's really important as a business owner that either if you're not reviewing it monthly, you absolutely need to be reviewing them monthly. You need to understand what they mean. There's ways that you can interpret them. A lot of times you'll hear financial statement ratios, and to some of my clients, it just goes right over their head. It's a little bit too complex. What I did is I put in the back of the packet some key financial ratios and how to calculate them so that you can do that for your business as you go through. It's always good to look at these ratios over time. Just like we looked at the P&L over by month and the balance sheet by month, to calculate these and look at the trend over time is really helpful to give you a better idea of what's going on in the business. So I'm not going to run through all of these. You guys can look through them and call me if you have any questions on exactly how you can calculate them for your business. But these are some of the critical ones that will, again, help you interpret the data instead of just looking at numbers. The other way to spot the bear is to use charts. And of course, I'm a very visual person. I like using charts and graphs to identify an issue. It's one thing with an educated eye, I can look at a P&L and I can see some of these things straight out of the box, but this actually tells me a very good story, well, yeah, quite a good story in a very short period of time. It helps me spot the bear without having to number crunch the way you technically could, going through reams and reams of spreadsheets. So again, if you take these reams and reams of numbers and throw them on some charts, you'll really start to see the story of your business. But then you take that one chart and you put it together with a lot of other charts, and you really do have a good story of what's going on in the business. And this is called a dashboard. It's full of what we call key performance indicators, or some of the critical financial metrics. So instead of reading through all of this data, we kind of pick out some of the key performance indicators that are relevant to your business. So if you're struggling with cash flow, we'll pull out some of these metrics that are on this sheet that are relevant to cash flow, and making sure we're keeping track of, being proactive and preventative when it comes to managing your cash. It tells a story. So, Larry's landscape design, the revenue is starting to spike. You can see he's also taken on a lot of debt. This is total liabilities. This is his cash balance. So it's starting to go down a little bit. But what we like to see is a cohesive view of what's going on in the business. So sales can be great, but your profit margins may stink and you may have no cash. So you may be in that situation like we talked about before, in that one example where you have $400 on your P&L and nothing in the bank, or negative in the bank. This is an open AR by a customer. So you can look at who makes up a bulk of your AR. There's lots of different things that you can do. And look, you don't need a fancy front-end tool like we have, but you can also do it in Excel. And if you have a staff, or even if you can set it up yourself or want us to come in and set it up for you, it's not that difficult to do, but at least it will put in perspective what's going on in the business. And we recommend that at least monthly you review your financials. If not, the AR and AP we look at least weekly, bi-weekly, to look at what's still out there, so you know. Bill.com is a bill payment add-on to QuickBooks. So what we have clients do, their vendors send invoices directly to Bill.com. They get emailed to them. The bookkeeper processes them. It synchronizes with QuickBooks, and it allows you to pay your vendors electronically without having to cut paper checks. So, for example, we'll have a vendor, they'll send the invoice, you can approve it, and then you can actually cut a check. Bill.com will cut the check on your behalf, almost like online banking, but you can do it right from your smartphone, and it's easy. And then it synchronizes with QuickBooks, so that your bookkeeper doesn't have that double entry of entering the vendor payable and also the payment. It synchronizes both ways. The question was, when I talked about Bill.com, I also mentioned accounts receivable. Bill.com has an accounts receivable function where you can send your invoices out of Bill.com. It's a new feature. We haven't used it with our clients yet, but it's the way that we're going. You're seeing a lot more of those technologies allowing you to send invoices electronically and have your clients pay you the way that your Fortune 100s pay you right now. So the question was, does Bill.com have a workflow feature in it? So yes, it does, meaning that the client sends the invoice into Bill.com, and the office manager codes it, and then they can route that bill, that image of that bill, to whomever they need to in order to get approval. So that person will then approve it within Bill.com. It goes back to the office manager and then gets synced back to the accounting system. So it's a nice workflow feature. Sounds like a commercial for Bill.com, right? It's a nice, what's that? There's the pricing. Yeah, Bill.com is a great feature for larger organizations where you have multiple people making purchases on your behalf, yet do not see the actual paper invoices. We've saved a client a ton of money because now their purchasing people actually see the bills that come in and have caught a lot of errors of, we didn't order this is the wrong part, they weren't supposed to charge a shipping and they did. So that gets kicked back and then we get the revised invoice. So it's a nice feature for those who have multiple approval processes. And then also too, we use it for some internal, helping our clients, direct them into which bills we've agreed that they're going to pay. When we do our cash forecast, we say, okay, these are the bills, these are the checks we're going to cut this week, so we can queue them up for them, and all they have to do is go on their smartphone and actually trigger those payments. So, does that make sense? Any other questions? Well, thank you very much. I really appreciate the opportunity. Thanks again.